In this week's video, we'll review a wide range of charts and data sets to help us answer the question, will inflation change everything we know about investing and asset allocation? Clients and regular viewers may remember back on July 9th of this year, we performed a maximum drawdown study based on the S&P 500 making 7 consecutive new all-time highs. And one of the reasons why we perform those studies when the market's rising and when the market is healthy, because we know inevitably, even within the context of the strongest bullish trends, that eventually the market is going to move backwards, have a give-back period, or a correction. So when we have probabilistic lines in the sand based on these maximum drawdown studies, it gives us logical reference points when things are not going particularly well and the headlines are scary, as they were on October 4th when the S&P 500 made its recent closing low. Using these hypothetical reference points on the right side of your screen, at the low on October 4th told us that for the most part, the market had come back to an area that really wasn't particularly surprising. This was the median and average drawdowns based on the historical drawdowns. You can see they came in right around 4,300. The closing low was 4,300 down in this area here. The horizontal lines were our hypothetical reference points based on the historical study, and the historical study was based on something that had just happened in calendar year 2021. If we walk forward to the close on Thursday, October 21st, we can see the S&P 500 has printed a new all-time closing high. And clients and regular viewers may also remember that in the past several weeks and months, we presented several maximum drawdown studies that told us the June low was a pretty good reference point relative to a probabilistic bull-bear demarcation line. As you can see, at the low on October 4th, we remained well above that June low. And since we're always looking for hard data that might contradict the secular trend thesis, when the market was falling in mid-September, we conducted this similar trend study that we covered in the September 17th video. That study told us that in the similar periods, the drawdowns in the S&P 500 looking at 107 calendar days, which would hypothetically take us to year-end in 2021, were also relatively muted. And in those historical cases, if investors were able to withstand the volatility, in every single case, they were rewarded in a big way when the S&P 500 was higher 2 years later, 3 years later, 4 years later, and 5 years later. Thus, the study that was presented on September 17th also provided some reference points when the market was falling in the form of these dotted horizontal lines in your screen. We did push the envelope, came all the way down to the last horizontal line that was drawn just below 4,300. Once again, we're not using this to predict anything. It's just telling us, based on that study, on October 4th, we really hadn't seen anything yet that it was out of line relative to these historical cases. And these historical cases told us, if that was the case and we continued to follow the script, then we should be ready for good things to happen for a long period of time. This was a look of the chart on October 4th when we had all the scary headlines and we had a ton of red on our screen. Here's the same chart on October 21st after the S&P 500 had tacked on 249 points from this low here. There are always legitimate things to be concerned about in the market. And even though the S&P 500 printed a new all-time high on Thursday, October 21st, we know that rising inflation can impact Fed policy, and Fed policy can impact interest rates, and interest rates can impact the longevity and viability of a bull market. And even within the context of a bull market, rising interest rates can change leadership relative to asset class behavior in a significant manner. All of the headlines shown on your screen were from this week. This headline here dated October 21st. In the upper right-hand corner of your screen, you can see the producer price index really didn't make a lot of progress between calendar year 2007 and 2020. Got a long-term consolidation box here and then a shorter-term consolidation box that goes back to approximately 2011. pretty fair to say that the reading in September of 2021 looks significantly different and maybe more concerning from an inflation perspective than anything that we've seen going all the way back to calendar year 2007. Since this is an observable and significant change, it might be helpful to get some historical perspective. If we take this same chart and we look backwards, now we're looking at the producer price index between 1982, lower left-hand corner of your screen, and the present day 2021 in the upper right-hand corner of your screen. As we just covered, we have a period of long-term consolidation and what looks to be a breakout above this consolidation box. You can make an argument that we have something similar in the early 1980s. Consolidation box between 1983 and 1987, and this look here is significantly different from anything in here. So this look where my cursor's moving around in the lower left-hand corner of the screen is similar to this look up here in the upper right-hand corner of the screen. And you may be thinking, this is the early 1980s here, and you're taking this box to roughly 1988. Haven't we talked about that period before? We have, in a recent demographic video. The oldest baby boomers turned 35 in 1981, where my cursor is. Something similar happened with the millennials. The oldest millennials turned 35 in 2016. And in that detailed demographic analysis, we drew the conclusion from one perspective that demographically 2021 was similar to the 1986 to 1989 window. So let's cut and paste this text here onto the producer price index chart that we were just reviewing. If this period in here, this big move above the box, is significantly different than what we've seen in here. This is significantly different than anything that we've seen back here. And reviewing the data, from roughly the end of 1987, where my cursor is, to the peak of the bull market in March of 2000, the producer price index increased significantly. Here's a steep slope here, very, very similar to the steep slope that we have in the present day. Thus, it might be helpful in the present day to ask and answer these three questions. Number one, did the stock market perform poorly in this period from point A to point B when the producer price index increased significantly? Number two, did the tech-heavy NASDAQ underperform the S&P 500 during a period when producer prices were increasing significantly? And number three, did industrial stocks or the Dow beat the NASDAQ? So to answer that question, let's look at the performance of the S&P 500, the Dow, and the NASDAQ between this point A here, the last day of 1987, and this point here, the spring of 2000. Did stocks perform poorly? The answer is a definitive no. During this period when PPI increased significantly, the S&P 500 tacked on an additional 457%. And we know the narrative in the present day is when prices are rising or when we have increasing inflation, that's bad for the tech-heavy NASDAQ. That's not good for growth stocks. It's not good for tech stocks. Thus, we might expect in this period that the tech-heavy NASDAQ significantly underperformed the S&P 500. That's not what happened. The NASDAQ, the tech-heavy NASDAQ, crushed the S&P 500, 457% to 1,402% over the same period. Question number three, did the more conservative Dow beat the tech-heavy NASDAQ? Once again, the answer is no, 473% to 1,402. Now, our purpose here is not to play down the topic of rising inflation or the topic of Fed policy or the topic of interest rates and the potential impact on the stock market and asset allocation decisions, but rather to show the narrative that's going around in the present day from a historical perspective isn't necessarily how things are going to play out walking forward, and we can make that statement based on history. So we've just shown that there's a period where the average selling price for goods and services was rising significantly and stocks did extremely well. and tech stocks did extremely well. It's also important to respect and understand the other side of the coin. What does it look like when inflation becomes a problem? Top portion of your screen is the CRB index, physical commodities relative to the S&P 500. And we have data going back to 1956 where my cursor is, and we're looking into roughly 1980 on the right side of the chart. The smaller chart shows the inflation rate over the same period. Here's 1960 for the larger chart. Here's the inflation rate in 1960. Here's 1980, larger chart. Here's the inflation rate in 1980. Thus, from an asset allocation perspective, this period in here is a period where you would want to consider adding commodities or inflation-sensitive assets to your portfolio. And if you know your inflation and U.S. economic history, you know 1972 into 1973 and into the devastating 1973-74 bear market was not a particularly favorable period for stock market investors. So if the present day looks like this and inflation looks like this, that would be concerning. So let's look at the same ratio on October 21st, 2021. Let's go back to the concerning period. The ratio of commodities to stocks. First of all, you can see the ratio goes above a flattening 50-month moving average here in the late 1960s. And then in the early 1970s, as inflation is rising, the CRB stock ratio starts to somewhat skyrocket and goes above a now turning up 50-month moving average. So in the present day, do we have something that looks similar to this concerning turn here? Very, very difficult to say the answer is yes. Right now we have a ratio that's clearly in a downtrend. The ratio is below a downward sloping 50-month moving average. Look at the slope of the 50-month moving average right here where my cursor is, relative to this look here, and even this look here. And notice, well before the 1973-74 bear market in stocks, look where the ratio is here. This looks different from anything that we had seen back here where my cursor's moving around. Do we have anything like this in the present day? We don't. The ratio hasn't been above the 50-month moving average since 2011, 2012 in here. Thus, it's pretty fair to say all of this up here really doesn't look like the present day. This is still helpful because if the present day starts to morph into something like this over here, our concerns about asset allocation decisions and our concerns about inflation's potential impact on the economy and the markets would increase. That may happen over here. It just hasn't happened yet. Also noteworthy, if the present day really doesn't look like this period up here, it might be helpful to know it really does look something like the 1987-1988 period. And we've proven in a past video that 1987-1988 is in that demographically similar window of 1986 to 1989. Compare the look of the chart in here to the look in here. Here's the 1987 crash and the aftermath of it. When the ratio starts to rise, it comes back toward a downward sloping 50-month moving average, but it remains clearly in a downtrend. After the COVID crash, we move away from a downward sloping 50-month moving average, and like this, after the 1987 crash, we somewhat revert to the mean, and we're coming back to a downward sloping 50-month moving average. So demographically, we've talked about similarities between the present day and this period here. And I think it's fair to say this look in here unequivocally looks more like the present day relative to this concerning look over here in the 1970s. Also noteworthy, see how this follows this? We have something similar over here. This period, eventually we get to this period. This period, eventually we get to this period. All right, we've just shown that the behavior of physical commodities relative to the S&P 500 is discernibly different in its present form relative to this period here where high inflation derailed both the economy and the stock market. Another point that we can make about this period, and see when things start to go sideways in the early 1970s where my cursor is, we also have a problem with inflation. And it's not just inflation that's a problem in the early 1970s. This is a period of stagflation, where both the economy and inflation are a problem. You can see from 1969 to 1975, the unemployment rate was increasing significantly. So we've got a period of rising inflation and rising unemployment. You may remember during the Carter years, the term misery index was coined. That's the unemployment rate plus the inflation rate. So misery is high when inflation is rising and the unemployment rate is rising. Life is tough when you can't get a job and prices are increasing. So we said in the present day, if this ratio in the present day takes on a look more like this and here, our concerns would increase. Our concerns would also increase if the unemployment rate starts to look like this period from 1969 to 1975. And we know if we look at the unemployment rate in the rearview mirror after the COVID plunge in the stock market and economy and the spike in the unemployment rate has been falling steadily. This is May of 2020, and this is September of 2021. Just like this over here. This is commentary about the chart in front of us. We're not predicting what it's going to look like in the future. And the same is true for the unemployment rate. If the unemployment rate starts to turn back up, similar to this period here in the late 1960s, early to mid 1970s, our concerns would increase. That may happen, but it hasn't happened yet. So we really don't have the conditions in place to start talking about stagflation. So do we have increasing inflation, increasing prices in the present day? Absolutely, positively, yes. But we've shown here that doesn't necessarily mean rising inflation in isolation or rising prices in isolation. That doesn't necessarily mean the stock market's dead in the water. This is a very attractive return, this is a very attractive return, and this is a very attractive return. Fidelity Investments has put together a graphic that does an excellent job helping us visualize all of this. You can pause your video player and you can follow along on Twitter. And the tweet does an excellent job summarizing the topic at hand. Lots of fretting about stagflation in recent weeks, but I see little evidence of it so far. Inflation boom? Yes. Stagflation? No. Here's a chart of PMI, which remains firmly in the inflation boom territory. This quadrant, bad thing, stagflation, high inflation, weak economy. This quadrant where we are now, rising inflation and a strong economy. This period here, rising prices and a strong economy. And notice the quadrant we're in the present day, inflation boom. That seems to align with, rather than contradict, the secular trend thesis. Let's put some other things in historical perspective. This is the Producer Price Index that we've been talking about. This is 1982 on the left side of your screen, the present day on the right side of your screen. You may have some counter arguments. One of them may be, that's the Producer Price Index. What about the Consumer Price Index? So let's look at the Consumer Price Index over the exact same period. So our analysis is from 1988 to the year 2000. Yes, CPI was rising in this period here, and the stock market did exceedingly well. And here's the big, but what about this? Interest rates were falling during this period. And it's very, very easy for the stock market to do well during a period of low rates or falling rates. That's a very fair and legitimate question. However, let's look at interest rates. over the exact same period, 1982 to 2021. The negative assumption for the stock market and for asset allocation decisions that could cause a big shift, let's say from growth to value type stocks, is that interest rates are now rising. And it's really easy to say that that's not anything like this period here. That sounds good, but is it really the case? So let's look at interest rates from 1982 to the present day, the exact same time period. And really what we want to know, has the long-term trend for interest rates flipped from down to up? The answer is no. This is the exact same period, 1982 to the present day. Draw a trend line, it's a downward sloping trend line. Interest rates, for the most part, have been making a series of lower lows and lower highs, and that has not changed. Yes, interest rates have popped back up, but that's basically because they dropped below the trend line during the COVID scare. We still have a long-term downtrend in interest rates until proven otherwise. In the bullish period that we covered in this video, we're in the same trend here. The trend is down. Yes, you have periods in here where rates rise, counter trend moves. It's not a straight line down. If we look at rates in the present day, have we made a significant higher high? No, we haven't. Rates would have to pop, 10-year yields would have to pop above 3% and really start to get to about 3.5% to make a higher high above this high that was made in 2018. So if we're expecting things to change significantly, part of that narrative, a big part of that narrative, is that the long-term trend for interest rates has flipped from down to up. That may happen very soon. We've been talking about it for years, decades, that it's going to flip. It may flip very soon, but it hasn't flipped yet. And these are the things that need to happen for the trend to change from this point to the present day. We need to break this trend line. Then we need to start making a series of higher highs and higher lows. Here's another fair question. Well, that all sounds great, Chris, and that is where interest rates are today. But the Fed's about to raise interest rates. That's going to change everything. Remember this period here from the end of 1987 to the spring of 2000 where stocks did exceedingly well? How many times do you think the Fed raised interest rates in this general window here? So the longer-term trend in interest rates, let's say from 1994, where my cursor is, to the spring of 2000, is down. So you might think that the Fed was lowering rates in here and that there were no rate increases in this entire window. How many times do you think the Fed raised interest rates, announced a rate hike between 1994 and the spring of 2000? The answer? 12 times. The Fed increased rates 12 times in the 1994 to 2000 window. If the Fed raised interest rates 12 times in the 1994 to 2000 window, and we also know in the 1994 to 2000 window, PPI increased significantly. Another fair question might be, when the Fed started to raise rates in 1994, did that kill the bull market? Said another way, how did stocks perform walking forward from 1994 to the spring of 2000? The answer? Extremely well. Interest rates, 12 rate hikes in this window here. From the end of 1993 to the spring of 2000, the S&P 500 gained an additional 227%. And during that period, PPI, or prices, pushed significantly higher. All of those returns and the economic data from that period speaks to a boom rather than a bust. How about asset allocation? Are market participants really preparing for extremely high inflation? This is the Pring Inflation Index. It's an index that tracks a basket of inflation-sensitive stocks. So here's the peak in 2008. Here's the financial crisis in here where my cursor is. Came up recently to the 50% retracement of this A to B decline and stalled. And really, this is just looking at one side of the coin. This is inflation-friendly stocks. What we really should be looking at is how did inflation-friendly stocks perform relative to deflation-friendly stocks. If market participants are really, really concerned about inflation, we would expect that inflation-friendly stocks would be crushing deflation-friendly stocks. Is that the case? Not really. This is the Pring Inflation Index relative to the Pring Deflation Index. You can see here's a low in 2016. Here's the COVID low in the stock market, March of 2020. We haven't even exceeded the high from 2016 in this ratio, and we really haven't done anything to significantly change what is clearly a downtrend. This is a period of consolidation. If it breaks in this direction, our concerns might increase. But look at this. This is June of 2020 here. Look where we are today. This doesn't look like market participants that are wildly concerned about stagflation in the future. Here's another way to look at it. Crude oil relative to the S&P 500. This is a very, very long-term trend. This is 2008. This is the 50-month moving average. We really don't have any evidence of a significant trend change yet. Is it knocking on the door? Absolutely, positively, yes. But this A to B move here, even from the peak in 2018, we're floating between the 50% and 61.8% retracement, and we're stalled at the moment at a downward sloping 50-month moving average. Not making any assumptions that this chart's going to move in this direction or this direction, but we don't have evidence of a trend change yet. The narrative in the present day is you really want to own energy stocks. You don't want to own tech stocks during a period of high inflation. We have had a massive inflation scare in the rearview mirror going back to the COVID low. Has the long-term trend for energy stocks, XLE relative to tech, has it changed significantly yet? It has not. It is clearly down. This is a monthly chart. If we look at the same ratio on a daily chart, XLE divided by VGT, which is a technology ETF, and then we zoom in, have energy stocks been crushing tech stocks? Energy stocks are supposed to be very inflation friendly. Tech stocks are supposed to be something you want to avoid during a period of high inflation. Thus, if market participants were expecting inflation to run rampant in the future, we would expect this trend line to be sloping up, not down. You can make an argument right now that June of 2020 is the peak of inflation fear. The ratio made a high here in June of 2020. It made a lower high in March of 2021, a lower high in June of 2021, and thus far we haven't even made it back to the downward sloping trend line. Is this a period of consolidation? Absolutely, positively, yes. Is this a period of consolidation? Absolutely, positively, yes. Is it possible that this ratio is going to skyrocket above this downward sloping trend line? Is it possible that we're going to break out here and skyrocket above the 50-month moving average? We all know the answer. It's absolutely, positively, yes. And it may happen very, very soon. But the short-term trend, that's not what we have, and it hasn't happened yet. We'll learn something if this ratio moves out here, and we'll learn something if this ratio moves out here. We have to ask ourselves, does this chart right here, especially since June of 2020, align with or contradict the theory that we're moving into a period of extremely high inflation? Similar situation here. Value stocks, the narrative goes, are the place to be. You don't want to own growth. You want to own value. Well, that ratio peaked in June of 2020. We fast forward to October of 2021, and we're well below that line. What that tells us is, since June of 2020, value stocks have underperformed growth stocks, and the short-term trend is not particularly encouraging either for value. The positive case, this is a period of consolidation, and if we get a breakout here, we would learn something, just as this is a period of consolidation. If we zoom into this area, can also make an argument that the fear of inflation has been falling since May of 2021. This is the value versus growth ratio in May of this year. This is October of this year. The narrative says you don't want to own tech, you want to load up on value stocks. The last 6 months, the ratio has fallen significantly and is significantly lower than it was in May of this year. And as of October 21st, year to date, value has underperformed tech. It is a fluid situation, and it is a situation that we all need to monitor with a flexible, unbiased, and open mind. Commentary here is based on the charts in front of us. If these charts change, then we have to be willing to reassess the probabilities. Earlier in the video, we showed these headlines. Here's one of them. October 21st, U.S. inflation expectations hit March 2013 high, which is basically saying inflation expectations in October of 2021 are identical for the most part to where they were in March of 2013. It'd be helpful to know. When inflation expectations were really high in 2013, how did stocks perform? Was the S&P 500 March of 2013? The answer is they performed exceedingly well in the short run and the longer term. This is January of 2018. This is the move in the S&P 500 index. How about this headline? Let's move this headline here in the lower right-hand corner of the screen onto the recent chart of the S&P 500. Global stocks struggle for direction as traders parse inflation clues. The subtitle, U.S. and European equity barometers sit within striking range of all-time peaks. If the stock market was overly concerned about inflation, we really wouldn't expect this move here, a sharp move back to a new all-time high. And as far as the health of the bull market goes, on October 21st, we're back to a full-bore bullish look relative to the trend. Price is above all of the moving averages. Blue, the fastest moving averages on top. Gray, the slowest moving averages on the bottom. And the slopes of all of the moving averages are up. So we're really not at a point here where we're debating whether or not we're in a bull or bear market. This is the more pressing concern. It is still possible that asset allocation decisions could change significantly in the coming weeks and months. But the look of this chart on October 21st tells us we really haven't seen anything that says we're off of the base case, where historically the stock market did exceedingly well looking out 2 to 5 years. 5 years out, average gain in the S&P 500, let's call it 75%. Recent demographic analysis, 5 years out, 76%. And from a fundamental perspective, consumers' balance sheets, the health of their balance sheets, and the health of the credit markets, all of it aligns with, rather than contradicting, the secular trend thesis. There were numerous factors that led to the devastating 1973-74 bear market in stocks, including an extremely rare and violent spike in oil prices that took place in the 1970s. We had an unemployment rate that had been increasing for several years, and the inflation rate had been increasing for several years, beginning in the mid-1960s. A lot of people were being laid off, and jobs were hard to find. That is in stark contrast to calendar year 2021, where we're seeing headlines like this. This is a first. The U.S. has 10 million job openings. Unlike the stagflationary period in the 1970s, if you want a job in the present day, you can find one. The stagflationary period, high inflation, and a weak economy. Significantly different from 2021, where we've seen headlines like this. U.S. job openings rise to record high. Layoffs hit record low. And given the unemployment rate had risen from 1969 to 1975, it'd be very, very difficult to use the term boom in this period. On the other hand, calendar year 2021, with positive inflation and a strong economy, seems to fit very, very nicely with the term boom. And we all know the only way that we're going to effectively use a chart like this and make the proper adjustments going forward if we do see a significant change from an asset allocation perspective. And the only way that we can properly recognize a change in the long-term trend is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.